The VIX. Here's the setup. The VIX, you've heard of it, the so-called fear gauge of the stock market, closed at 16 times. That is calm. That is sleepy. That is the market telling you everything is fine. The S&P is sitting around near 7,500, close to record territory. On the surface, it's one of the quietest markets we have seen all year, believe it or not. But underneath that calm surface, individual stocks are going absolutely wild. There is a second gauge, one most people have never heard of. It's called the VIXEQ. It measures the expected volatility of the individual companies inside the S&P 500 instead of the index as a whole. And right now it is sitting near 47. The gap between these two numbers, wild individual stocks, calm overall index, recently hit 30.8. That is the widest gap ever recorded since the data began published in January of 2023. The old record from last October was 24.7. We did not just break the record, we shattered it. So today we are going to do three things. First, understanding. I'm going to teach you exactly how to read this chart so you see what the professionals see. Second, uncertainty. We are going to be honest about the fact that nobody exactly knows how this resolves, and we will map the full range of outcomes with real possibilities. And third, urgency. Because whichever way this resolves, the move has likely already started, and the investors who understand the mechanics will be positioned before the headlines catches up. And here's a part that makes this channel different. Most commentators look at this record-breaking gap and scream, crash! We're going to take the other side of that conversation seriously because history says this exact setup always marks some of the greatest stock picking environment of the last 50 years. A black swan is not always a disaster. Sometimes the rare underpriced, underexpected event is the one that pays you. Before we dive in 2 seconds, and really 2 seconds, this is a kind of deep, plain English market analysis should be valuable to you. Please subscribe and tap the bell because these breakdowns take days to research. And YouTube only show them to subscribers. And if you want my full weekly scenario and daily report and all 10 of my additional tools, become a member. So here it is. Let's put the chart on the screen and take it apart piece by piece. Because if you understand this one image, you understand the entire market of mid-2020. Let me translate every element. The VIX is the orange line at the bottom panel. Right? It is calculated from the prices of options on the S&P 500 index itself. Think of options as insurance policies on the market. When insurance is expensive, it means people are worried and the VIX is high. When insurance is cheap, people are relaxed and the VIX is low. Right now, it reads at about 16, which historically means calm seas. For perspective, in the panic of March 20, it hit 82. This past March, during the geopolitical scare, it touched 35. Today, it's 16. The insurance of the whole market is cheap. The black line, the blue line, the black line is the VIXEQ. Think of it as the VIX louder, more excitable sibling. Instead of measuring insurance of the whole index, it measures insurance on each individual company inside the S&P 500. Apple, Nvidia, right? Micron, all of them. And then blend these together, weighted by company size. That number is sitting around 47. Is a circle? So, insurance on the average big American stock costs roughly 3 times more than insurance on the market as a whole. Now, take a look at the top panel. The blue line is simply the black line minus the orange line. The spread, that is where history is being made. In early June, that spread reached 30.8, the widest ever recorded. Even today, with markets calm, it remains near record territory. To put it in plain terms, the options market is saying individual stocks will be extremely bumpy while the overall market will be extremely smooth. At the same time, to a degree never seen before. How is this even possible? And here's a kitchen table version. Imagine 10 kids, right? On the playground. If they all jump and down together, the whole playground shakes on a seesaw playground, right? That is high correlation and the index gets volatile. But if half jump up exactly while the other one half jumps down, their move cancel that. Each kid is moving violently, but the playground as a whole barely trembles. That is what is happening to the S&P right now. Nvidia surges while healthcare stock slides. Micron rips high on earnings while the consumer name sinks. The individual moves are huge, but the net move is tiny. Wild parts come whole. One more crucial detail before we move on. The market has a gauge for exactly this cancellation effect. It is called the implied correlation index, Core 3M, and it measures how much traders expect stocks to move together over the next 3 months. So let me answer that question. I know some of you are already asking and shouting at the screen. Is the VIX just broken? It is a fair question. A gauge reading calm while the market, the parts is measuring, screaming is suspicious. But here's the honest answer. The VIX is not broken. It is doing precisely what it was designed to do. Measure expected volatility of the index. Generally is calm because of the cancellation effect we just described. The problem is not the thermometer. The problem is that we have all been using one thermometer to take the temperature of 500 different patients. The VIX tells you about the forest. The VIXEQ tells you about the trees. And right now, the forest is silent while trees are on fire. The other half are blooming, which nets out from a satellite view to a perfect average looking forest. Once you understand that, you stop asking which gauge is lying and start asking the much more profitable question. What happens when a market is built this way and who gets paid when it changes? It closed at 7.81. That all-time record low is 7.6 set in July 20. We are a whisker away from the lowest expected stock-to-stock correlation ever priced by the options market. Traders are betting with real money that American stocks will keep marching to completely different dramas. Hold that thought, because what happened after July 2024 is one of the most important history lessons in this entire video, and we will get there shortly. So you see, what this is telling you is that stocks are behaving independently of each other, which is fantastic. We talked about that in a previous video, where essentially it's not like you have 7 stocks and you have to focus on the 7th. Well, maybe AI is not doing so good, but it's only 7 stocks. There's a bunch of new stocks happening. You want that diversity. You want that dispersion. Doesn't mean they're all dispersing the same way. Of course, depending which one you want to read, you say, wow, look, healthcare is not doing great, so the market is bad. Hold on. That's the reason why the VIX is kind of like that. Walk with me through the year. January and February were quiet. VIX in the mid-teens. Markets grinding high on AI enthusiasm. Then March happened. Geopolitical fears around Iran sent the VIX to 35. It's 52-week high, with daily whipsaw moves across the whole market. That was a high correlation moment. Everything fell together. Everything bounced together. Then something remarkable happened. As the immediate crisis faded, traders did not go back to worrying about the market. They went back to worry about individual companies. In the world of Mandy Su, who runs derivative intelligence at CBOE, the exchange that publishes all these indices, stock dispersion became extremely elevated and correlation levels fell to historical low as traders switched focus from macro risk like Iran to stock-specific catalysts like AI earnings. That single sentence explained the entire chart. June gave us a perfect miniature of the new engine and the new regime. Early in the month, a sharp sell-off in tech stocks, anxiety about inflation, a hawkish sounding Fed pushed the VIX up to 22 on June 10th. Broadcom actually beat earnings, but its guidance fell short of sky-high expectation, and Semiconductor got hit. Then Micron delivered blockbuster results, and the sector roared back. A framework to reopen the Strait of Hormuz calmed geopolitical nerves, and the VIX grows at 16.4. The index round tripped, but underneath, single name insurance price never came down. Look at where the wildness actually lives. Do you see it? Right? The average big stock is around 47, the blue bar. Options on the semiconductor ETF over 50, more than 3 times the index on the left. And Micron, at the peak of its earning drama in late May, carried an implied volatility near 102. That means the option market was pricing moves for Micron consistent with the stock potentially doubling over a year for one of the largest chip companies on earth. And the money flowing into this is staggering. According to data tracked by Citadel Securities and reported by CNBC, the total options premium traded across semiconductor stocks recently ran 25% above the previously recorded for March 2024 and 5 times the historical monthly average. The semiconductors options market is now generating more activity than many entire national stock markets. Meanwhile, the everyday investor crowd has been enthusiastically buying single stock call options, bet on more upside at a pace that by CBOE owns data has only been matched twice in modern history. The meme stock frenzy of 2021 and the late 1990s technology bubble. So that is a new layer, a geopolitical scare that came and went, an AI earning machine that keeps forcing traders to reprice individual companies week by week, and a flood of options money chasing single names while ignoring the index. This is a fuel. Now let's look at what history says happened when the market gets built like this. We have seen this movie before. Whenever a market indicator hits at all-time record, the honest first question is, how much history do we actually have? For the VIXEQ minus VIX spread specifically, the answer is since 2023, 3.5 years. That is a short book, but the underlying phenomenon, calm indexed, wild stocks, low correlation, has a much longer history. It is far more encouraging than the Doob headline suggests. Case 1, look at the late 90s. From 1995 to 1999, stock-to-stock correlation inside the S&P fell to what was then historic lows. Technology stock lived in one universe. Old economy stocks lived in another. Individual names swung violently on earnings while the index climbed at steady staircase. And what did the S&P 500 do across those 5 low correlation years? Up 34%, up 20%, up 31%, up 27%. 5 consecutive years of double-digit gains. Yes, the party eventually ended in 2000, but the low correlation regime itself lasted over a decade, and investors who fled at the first record-breaking dispersion missed one of the greatest wealth creation runs in market history. Case number 2017, the calmest year in modern VIX history. The fear gauge spent most of the year below 12 and touched a record low of near 9. Commentators spent the entire year warning that the calm was artificial, that volatility sellers had broken the market. The S&P rose 19% with barely a 33% pullback. The reckoning did arrive February 2018, the famous Volmageddon, but when bet gets a volatility blew up and the VIX doubled in a day. Real painful fast, and here's the part everyone forgets. The S&P 500 recovered the entire drawdown within a month. The lesson was not that calm markets are safe forever. The lesson was that the unwind when it came was violent but brief and punished one single crowd trade, not long-term investors. History also says the rubber band does snap back. The spread does not stay at records forever. So the intelligent question is not whether it normalizes, it is how. And to answer that, you need to understand the machinery. Why the fear gauge fell asleep? This is a question. This is a section where we go one level deeper than the headline. The structural intricacies. Stay with me because I promise to keep it in plain English. Now, why is the VIX been near 16 while individual stocks trade like penny stock? 3 interlocking mechanisms are doing it. Number 1, the dispersion trade. This is a strategic run by some of the biggest hedge funds and bank trading desks in the world. And at its heart is a beautifully simple insurance on individual stocks is expensive right now. Insurance on the index is cheap. So the trade is buy the expensive but explosive single name stock options, pay for them by selling the cheap index option. As long as stocks keep moving independently, one up, one down, canceling out, the single stock option pays off richly while the index option you sold expired quietly. It has been one of the most profitable institutional strategy of the past 3 years. But notice the side effect. Every time a fund sells index options to fund the trade, that selling pressure pushes index insurance prices down, which pushes the VIX down. The trade does not just exploit the calm index, it manufactures it. The more popular the trade gets, the calmer the Fed look. It's a feedback loop. So the positive Black Swan, right? What if this is the setup, not the warning? And that gets to the heart of what this channel stands for. A Black Swan is a rare, high-impact event, but everyone reflectively assumes Black Swans are crashes. They are not. And I want to make the serious evidence-based case that the record on your screens may be pointing to a positive one. Consider what a record-wide spread between single stock and index volatility actually means stripped of fear. It means the market has stopped treating the S&P as a blob. For 15 years, the entire era after the 2000 crisis, the dominant complaint from professional investors was that everything moved together. Central bank flooded the system, correlations were high, stock picking was nearly pointless, and the index funds won by default. That world seems to be ending. Companies are once again rising and falling at their own merits. Their earnings, AI strategy, their execution. This is not a malfunction. It is what a healthy, discriminating market is supposed to look like. We simply have not seen one in so long that it registers as an anomaly. And that, my friends, is, I think, the reason why they're making the money and you might be losing. Because it is so complex, to some extent, that all you hear is the market is going to crash any moment now. So you are selling while they're buying until you realize that's not happening, and then the market goes back up again. And that is a reason you need to watch this market very carefully, but not through the lenses of, through their lens of basically building a narrative around what's going on, but understanding what's going on. And I mean, yeah, you can't do it in one video or one membership, right? And this is a reason with my membership, I have 10 separate tools that I keep feeding my investors one with, right? I mean, I tell them about these are the stocks that I'm looking at. These are the trades that I'm doing at. These are the trades that I've done and unwind, and look what they're doing today. You know, this is what the quants are doing. This is where the risk lies. These are the things that we don't know yet are going to impact us. And every day we look at the S&P, we look at the VIX, we look at the 10-year, we look at the move, we look at the goal, where we learn, we tinker every day. You have to tinker in order for you to be successful in the stock market. And you need to tinker every day.